And so our goal was embodying this idea that every company is a tech company, to create systems and software if it didn't exist for us, or even hardware. And if it does exist and it's out there and we can find a really efficient way to use it, that's great. And we need to hire people who are going to be very efficient users of technology. And we need to think about ourselves as a technology company. The result of that for us has been we manage more production per employee than any other company in the country. And we're able to do that while still operating at significantly less operating expenses per unit than other companies that are our peers, because we've embraced technology, where we've shifted the thinking from tracking things in spreadsheets to being tracking things in databases, where we were able to write customized software solutions for what we've needed, where we've actually created industrial scale software for solving some of our biggest problems around how to more accurately and quickly underwrite acquisitions, which is important to us as an acquisition company. My hope is that you could start blurring the lines between saying that, oh, they just produce oil and gas, to saying, well, they're using technology to produce oil and gas, and they're using it to produce it way more efficiently than other people are.
Our growth or acquisitions concept, which is kind of really what Presidio was really kind of because we could exercise what we're good at as far as well management itself and not taking this capital risk. And at this point, the growth or acquisitions just has a totally different risk profile. And so as we approach it, as we review it, and Andrew, maybe you have some thoughts here too, is sort of our standard way where we had success in the past of being able to grow through acquisitions. The world's turned enough to where if we want to continue to grow through acquisitions, we probably have to do that through a different thesis, right? It can't be mostly cost cutting and risk management. There's got to be some other synergy that goes with it that we haven't quite explored yet, that's going to be different from what we've done in the past, if we want to keep growing through acquisitions in this environment, right?
That's right. That, or we let the environment come to us a little bit more as well. There's no reason to get overly aggressive whenever our base business is doing so well. And so we have that nice opportunity to be selective in the deals that we do. And so, my thought is that the market hopefully starts improving the bid-ask spread. People realize that it is a very high pricing environment. Now might be a good time to get out of some assets. And some of the realization is that those people need to figure out that they're not going to get PV15 in a 50-year inflation adjusted high and pricing environment. And so, I think some of that realization is starting to sink in. However, we're starting to hit that hold point where it's just, and that kind of goes back to what Chris was saying. It's a little bit more valuable to hold, and you can go pick up a drilling rig or two of your own. So, getting creative with some things. We might have some opportunities with some larger companies that, might not be as concerned with getting their timing right.
Yeah, the market feels pretty gummed up right now. We're not willing to raise our prices. I mean, we do believe in growth through acquisitions, but we don't grow for the sake of growth. It's growing where things are accretive and to our equity value and to our asset quality and other metrics we have. And if people aren't willing to transact there, then we're just not going to transact.
We're patient fishermen. Sometimes we don't transact the first time around. We keep our bait out in the water, and we're starting to get some people who are starting to capitulate on what their expectations were originally, and getting down into a little bit more realistic targets, if you will.
And going back to the contrarian thinking, and we can talk about what the world was like in 2016 when we were putting this idea together. Again, we had 95% of capital that were going into these more venture type projects. And we have 5% of the capital going to go buy existing producing properties. And so just on the face of it, I would say to myself, okay, the companies, for instance, back in 2016, who were publicly traded, who were able to issue equity to go acquire acreage, they were trading at 20 times enterprise value to EBITDA. Whereas I could go and buy an existing producing cash flowing property for 2 to 3 times EBITDA. So just from a value investor standpoint, which we very much view ourselves as value investors, when we saw an opportunity to buy assets for dramatic discounts to what the market was trading other types of assets for, we were attracted to those assets. That was part of the contrarian thinking. No one else was doing it. And frankly, we made things very hard on ourselves because of that. In our first 18 months in business, we weren't able to raise a single dollar. And we had a lot of terrible meetings with investors because people generally thought that what we were doing was stupid. They said, why would you be investing in assets that are trading for 2 to 3 times cash flow? There's a reason why they're trading for 2 to 3 times cash flow. It's because they're bad. Whereas we can go buy this growth stuff for 20 times cash flow, but boy, it's going to grow so much that it's going to pay for the fact that we have to pay so much for these assets. And we thought that that was wrong on a couple of fronts. Number one, when you see 95% of capital going into this, it's huge sums. The total amount of free cash flow, and then it became negative free cash flow for the industry between 2010 and 2020 was almost $400 billion. So the industry invested almost $400 billion in generating new oil and gas production in the US in a 10-year period. That to us said, there's going to be a lot of oil and gas. When there's a lot of oil and gas, prices tend to go down. So number one, we thought eventually there was going to be a time when we were going to drive prices down because of the great success that we were having in developing these new reserves. And we'd observed that on the natural gas side, where the initial shale boom on natural gas had knocked prices down significantly. And then we got to a point, in 2016 when prices were at all-time lows below $2 an MCF, because we were so good at unlocking those new reserves and that new production. What we've been able to do in each one of these acquisitions has proven out a different piece of our business plan. And the first acquisition was just the proof of concept. Can we go acquire an asset? Can we go cut expenses? And I think in the end, our underwriting on those assets was to cut expenses by about 35% in the first 6 months of owning them, and we were able to achieve a 50% cut. That was on 115 wells. And so we said, okay, we've got the mousetrap, we have the playbook for how we're gonna go implement this. Now we need to go do it at scale. And we started talking to Templar and Apache about buying their companies. Eventually, Apache came to market. We won those assets at an auction. And basically 1 year after acquiring our Mid-States assets, we acquired the Apache assets. The key lesson for us there was, can we do what we just did on this small set of wellbores? It was 115 wellbores at Mid-States. Can we do it at scale? And so the Apache assets had 1,500 operated wells and interest in 1,500 non-operated wells. 9 months into that acquisition, we had successfully cut the expenses by 50% on the Apache assets. And now, we've cut more than that 2 years later. We felt very good then that, the first acquisition had said, can we do it at all? Yes, we can. The second acquisition was, can we do this at scale? Now, we have 3,000 wells, 1,500 operated, 1,500 non-operated, 10x the number that we had before. Can we do it at scale? Yes. And we did it at scale. And so we got into 2020 and no one could have foreseen COVID happening, but we eventually did tip that scale on too much supply and not enough demand, and COVID accelerated that. I mean, we made more money during COVID because of our strategy than we had budgeted for 2020, because we had hedges in place to support our revenue side. And on the cost side, our cost came down even further than we had expected, even below those 50-60% cuts, because of the general cost deflation going on in the oil field because of COVID. So yeah, we made more money than we had budgeted for 2020, despite the fact that at one point oil prices were negative. So the answer to our question was yes. Now we know that we can do it at scale, and now we know that our systems are so good, our people are so good, that they're able to take on doubling the size of the company overnight and immediately effectuate radical changes to the way that those wells are being operated, to immediately put our new field culture in, and to immediately start having success. That rolls us forward to 2021, where we, for the first year, didn't make an acquisition because in our continued desire to kind of prove out how this whole business model works, we knew that there had to be a way to finance this business for the long term. And so we've been working for years on new financing technologies, which would enable a business that's like ours, a production-heavy business, a cash flow-heavy business, to tap into a different investor universe. And that investor universe was investment-grade buyers of asset-backed securities. And so we ended up selling bonds in July of 2021, about $430 million. And it was a number of firsts, first-time issuance of asset-backed securities to a diverse set of investors and multiple hedge counterparties. So it was a diverse set of insurance funds, pension funds, and hedge funds. We had several tranches within the bonds, 2 investment grade tranches, 1 sub-investment grade tranche. And it was also the first time an oil and gas company had issued a sustainability linked bond. And that was globally.
Here's a thought exercise. It's the Peter Thiel, how do you accomplish in the next 6 months what you want to accomplish in the next 6 years question to help kind of uncover what our constraints are. Like if we want to own and operate 300,000 wells and we wanted to do it in the next 6 months, what would we need? Are we short deal flow? Are we short capital? Are we short, we're short personnel to underwrite the deals? Like what are our constraints?
I think deal flow is a definite one. I mean, if you summed up all the deals we've looked at in earnest over the past 6 months, well count's probably not, thousands and thousands and thousands. If you look at the previous 6 months or a year, we probably went through a lot. I don't know, Andrew, if that's what you've seen too. I know we've looked at a lot of deals, but a lot of them are smaller, and it just seems to be a little less volume.
Well, is it something where you have to broaden your thought process a little bit, and some of these talks about maybe looking at some of the larger public companies and some optionality there where they already have a large amount of wellbores that we could go and get a lot in one go?
Yeah, or maybe we could say it a different way. I know we often throw out the wellbores thing just because that's an easy measure, but it really doesn't mean anything. It's really dollars put to work. So we've put $600 million to work over the last few years. How do we put $1 billion to work over the next 6 months? And like the answers that jump into my mind are, if you had a infinitely low cost of equity, an equity source that had very low cost of equity that enabled you to defeat and beat these hold cases that everybody is running into. So everyone thinks your price is too low. That's because everyone needs to underwrite to a specific return because there's only a certain number of participants in the equity financing of these deals, and those participants know that they can extract a good return. So to me, a constraint could be lifted if you had $1 billion of 0% cost of capital equity, as an example. And you just go buy everything. Then you're probably, if you have that, then our constraint would probably be we don't have enough acquisitions engineers to underwrite all the deal flow we're going to get.
Yeah, you would have people knocking on your door in that scenario. So, I think too, if you're talking about compressing it into a 6-month time frame, then you've got to go bigger deals. I think that our time spent on a deal that's $1 billion isn't that much different than a deal that's spent on our time spent on a deal that's worth $10 million, or say 20. So bigger and quicker.
PV10 to PV12 was the number, right? And that worked for your business model. You could buy it all. Everybody right now would sell at that number. Development aside.
Yeah.
Everybody would sell at that number. Everybody would take that number. It stripped at that number. Everybody would sell. Now, it just comes down to Will's question of, what's your cost of capital and how do you make money at that, or a reasonable return at that threshold?
This is actually a pretty good session. I think this is uncovering a couple of things. I think one, I know these deals that have been in our backyard have been smaller, and so we've been looking at them because they're adjacent to us, but the reality is we should probably be spending our time looking at things that are bigger. And we should look at expanding our sources of financing as a part of doing a very large transaction.
That's why the model's been so successful. I know, you've talked to Will, and, we started off this business model thinking that we might be able to cut operating costs by 30%. That was really just kind of a swag in the beginning. Then we kind of saw an eye to 50%. And then, after the last couple of acquisitions, we saw an eye to 70%. And that was because we had developed that technology and that feedback loop with the field to be able to say, hey, listen, these are the way we're able to do things better. This is how we can do them faster and make them more seamless. It requires less people, and it gives the field guys the information they need to really drive the value. And that's kind of the secret sauce in the end. There's the acquisition strategy. I like to think that Will and I were ahead of things in the Contrarian strategy to buy PDPs. The underlying real proof, though, of making it work is empowering the field guys to make the decisions. If they can't go out there and do their job and do their job better, understand what we're trying to do, and give them the technology and the information they need, the business model doesn't work. So that's what we've been able to do that's different. It really is.